Equity journals need to be processed where transactions occur between the company and existing or new shareholders. These are usually in the form of the issue of shares, dividend declarations, or sometimes where a company buys back its own shares. To the examples we go again. Let's say the company Mr. Mac has recently secured the Vision Fund as a strategic investor, and the fund is to subscribe to 10% of the shares in Mr. Mac by way of a fresh tranche of shares being issued for consideration of $120 million Mac dollars. What would the journal entries process be for this transaction? Firstly, there would be a debit to the bank and cash account of the company Mr. Mac of $120 million. That would show the cash the company receives from the Vision Fund, which is subscribing to the shares. On the credit side, you would see a credit to the ordinary share capital on the balance sheet of $120 million. And that would reflect the equity portion because new shares have been issued and the ordinary share capital has increased. If you had to see the journal reflected in the T accounts in GL, you'd see a debit of $120 million in the bank account and bank and cash T account, and a credit of $120 million in the ordinary share capital account. Now, after 3 years of commercial operations, Mr. Mac has recently made a decision to pay its maiden dividend of $10 million. What would the journal entry be in this respect? Very, very simple. It would be a debit to the retained earnings in the balance sheet of $10 million. And because the dividend has been paid or distributed, there would be a corresponding credit of bank and cash in the balance sheet of $10 million, reducing the amount of cash in the bank account. If you had to see this journal reflected in the T account and general ledger, you'd see a debit of $10 million Mac dollars in the retained earnings T account and a credit of $10 million in the bank and cash T account.